Got it going. So I'll be showing y'all what's on my desktop, and then they're going to be people online are going to be seeing what's on my laptop, since I can't get the laptop to stay connected to that for some reason for longer than like 5 seconds. Whatever. Okay. So today we're focusing on stocks and bonds. Those are the main two avenues that you can choose to invest in. Stocks are also called shares. You buy shares of stock. Okay. So stock in and of itself represents ownership of the company. Okay. How many of y'all have watched Shark Tank? Okay. So the company always goes before the sharks and they present the sharks with an offer, right? $5,000 or $50,000 for 5% of my company. Sound familiar? Okay. So what they're offering the sharks in that sense are 5% ownership stake. So
Dr. Greer Braxton is on his way.
Okay, thank you. So they're representing they're asking for 5% ownership stake. They want 5% of the company's shares in that. Okay, so shares of stock are ownership. There are 2 ways that you can make money if you buy shares of a company. Okay, one, and this is probably the thing that most people think of, they want to buy low and sell high. Buy low, sell high. Hey, Braxton. The other way that you can make money with stock, with shares, is through dividends, as Leo was talking about, right? And a dividend is just the company makes a profit, right? They have revenue, which is good, but does revenue mean profit? No, they're bringing money in. That's good for revenue. What is profit? Revenue minus. What is profit? Revenue minus what? Think of it from your own self. If you have a job, you're making income. That's your revenue. Expenses. Okay. So revenue minus expenses is equal to profit. Just like for y'all, income minus your expenses is your savings, right? Or your spending money, right? So companies sometimes decide to share a portion of that profit with the owners of the company. And if you buy shares of stock, you are an owner of the company. Okay. Now, and that doesn't mean that all owners are equal, though, right? If you own more of a company, should you have a greater say in how the company is run? Yeah. And they do that through shareholder meetings. So you essentially get a vote for every share of stock that you own. So if you own 100,000 shares of a stock, you get 100,000 votes. Someone else only owns 100 shares, they only get 100 votes. You can outvote them. Okay. So that's kind of how it works. And the 2 ways that you can make money are either buying low and selling at a higher price, or you get paid in a dividend when that company decides to share profits with you. Okay. And they typically look at that dividend rate as a percent. So give me the name of a company. We'll look up its dividend rate. Let's look at Verizon. How many of y'all use Verizon? Okay, right. So Verizon, okay, right here, and let me move it on this one too. Okay, so right here you can see VZ. What is that called? What type of symbol? Okay, it's the ticker symbol. It's called the ticker symbol. So when you choose to invest in stocks, you're going to be plugging in the ticker symbol of the company. So you'll need to look that up. I use CNBC or Yahoo Finance, Morningstar. All these are different websites that you can go to look up different or financial information. Okay. So going to Verizon. Okay. How much is a Verizon stock right now? $59.30. Okay. And it's going to fluctuate. So if we look down here and let's just say, let's look over the past 3 months. Okay. Has it gone above 60 in the past 3 months? Yeah. Has it gone below 56 in the past 3 months? Yeah. Yeah, it has. Down at the very tail end over here at the beginning of August, it looks like it was around $54, $55 per share. Okay. What does it mean when a share price goes up? What does that mean? What's happening when share prices are going up? Not necessarily. You know, Tesla just became profitable for 2 quarters in a row. That's for 6 months. So each quarter is a 3-month period. So for the first time in Tesla's history, they've been profitable for 2 3-month periods in a row. And they've been around a lot longer than that, haven't they? Right? So what causes a share price to go up or what causes a share price to go down? Not necessarily. Think of this as other things that you choose to buy, right? If more people are buying something, what's going to happen to the price of that item? If more people are buying it, it goes up, right? Right now, I have a fair amount of guns at home, and right now, the price of bullets is a lot higher than it was a year ago. It was like a 9mm round was about 19-20 cents a round a year ago. Now 60 cents a round, up 3 times more. It's kind of that's a big jump. But why is that happening? Are more people going out and buying a lot? Is there a lot more uncertainty right now? Yeah, when there's uncertainty, people tend to go out and buy. Like when pandemic first hit, gun stores were running out of stock on stuff. Like they were selling out of everything. And then ammunition quickly sold out as well. Okay, so when more people are going out to buy something, what's happening to the price? It's going up. What about when more people are selling than people are buying? Goes down, right? So stock prices are the same way. Okay, so between August 15th to September 15th, we can see that more people were out there buying Verizon stock than they were selling it, than people were selling it. And so when more people are buying it than selling it, the prices are going to go up. Okay. That doesn't necessarily mean they may be buying it because it's that the company is more profitable. They could be doing that, but they could also be buying it because there's a lot of talk about it, right? Bitcoin, y'all remember Bitcoin? What record did it set? Y'all remember how high it got? Huh? I think 20,000. I think it got up to 20. Oops. Golly, let me scroll up. We'll go back to Verizon in a minute. Bitcoin is over here. It was higher than that. Huh. But a couple years ago, it got up to 19,000, 20,000, because a lot of people were out there buying it. But eventually more people started selling it than buying it. And so the price of Bitcoin fell to like 6,000. And so right now it's around 11,000 because more people are buying it than selling it, buying and holding it than selling it, right? So let's go back to Verizon real quick. Okay, so that's our price here, okay? And that's what dictates the price. If the price of a share of stock is going up, then more people are buying it than selling it. If the price of a stock is going down, more people are selling it than buying it. Okay. 52-week range, that just tells you the range of prices over the last year. So it went as low as 48 and as high as 62. Okay. I scroll down some with this stock. Okay, got the high, low. Okay, here we go. Dividend. So where it says dividend 2.15 or 2.51, what do you all think that is referring to? Is that the percent or is that the dollar value? It's the dollar value. Okay. So the 2.51 right over here, would it help if I turned off the lights? Yes. Okay. Do that real quick. Okay, so the 2.51 over here is the amount that they're going to pay you every year per share that you own. So if you own one share of Verizon, they're going to pay you $2.51. If you own 10 shares of Verizon, they're going to pay you $25.10. Because it's per share. Okay. And that amount, that 2.51, that's going to stay pretty much the same. Unless the company is going through some financial trouble, maybe they don't have enough cash, enough revenue to cover their expenses, and they have to cut some expenses, they may cut a dividend. Y'all know Shell stock? Shell, Royal Dutch Shell, right? They're a Dutch company. Okay. They were pre-pandemic paying around a 10% dividend. Really nice dividend to have. Pandemic hit, were people flying? No. People driving around as much? No. Were oil companies hurting? Are oil companies hurting? Yeah. So Shell, because they had less revenue coming in, they couldn't afford to maintain this 10% dividend. So they had to cut it, and their dividend rate fell. Okay. But they cut this dollar fee. Okay. This dividend yield, all that is what percent of this dollar figure compared to the price. So if you're to take out your calculator and do, let's see, we said the price was like $59, right? So $59 time and take 4.2 1%, you get about $2.50, $2.48. Okay. So if the share price is going up, but the dividend amount stays the same, what's going to happen to this yield? if the share price goes up to, let's say it goes up from $59 to $100, what would the dividend yield be if they kept the dividend rate the same? But what would it be? There's a reason I put the price up to $100, make the math easy. Huh? What percentage of $100 is $2.51? $2.51 is how much percent of $100? It's not a trick question. $2.15%. Because it's $100, so 100%, right? $2.51 is going to be 2.15 or 2.51% of $100. So if this share price of Verizon went up to $100, the dividend yield, and if they maintain the dividend rate of $2.51 per share, the yield is going to fall down from 4.2 down to 2.51%. Just the nature of the math. Okay, you're paying $100 to get a $2.51 dividend. Your yield on that $100 is going to be 2.15. Okay. Is that better than savings accounts right now? Yeah, it's still better than savings accounts. But a lot of people, when they buy stocks for dividends, if they see a 2.51, it's not bad. It's not something to write home about, right? Just average. Okay. So let's see, we scroll down. Okay, there are some things here that we can get into if y'all are interested, but I hadn't planned on going into this much depth. Right now I'm highlighting this debt to equity ratio. It's something that I look for when I choose to see, okay, if I'm going to invest in a company, and I look at the dividend yield. Okay, is it going to be worth my time to invest in there? And the dividend, the nice thing about dividends is if the stock price goes down because more people are selling it than buying it, does that affect the company's profitability? If more people are just selling the stock, does that impact the company's profitability? Does the company make money based on the share price, or do they make money because they're providing a product? Yeah, they're providing a product or service. That's how they make money. So if more people are just selling the stock and the price is going down, that doesn't necessarily mean that their revenues are going to be hurt. Okay, it could, but it's not. They're not caused. There's no causation there. Okay, so one of the things I look for is how much debt does this company have when I look for a company? Because if I'm buying them so they can keep on paying me a dividend, I want to make sure that they have enough cash flow and not a lot of debt. Because if they go bankrupt because they have too much debt, am I going to get paid my dividend? No, right? So I look here, debt to equity ratio. Equity is essentially kind of the value of the company. Okay. Does Verizon have more debt than what the company is worth? Why do you say yes? Yeah, their debt to equity ratio, they have almost 200% debt compared to what the company is worth. That is sending up a major red flag for me. Because if they have that much debt, they're going to prioritize paying the debt before they pay me, the shareholder. And as a shareholder, I want to be paid, right? Okay. So that's kind of that would be a red flag here. Okay. Positive revenue, that's good. Earnings per EPS stands for earnings per share. So they take all their earnings and they divide it by the number of shares they have. So do you want a company to have positive earnings per shares or negative earnings per share? Positive. You want a company that has positive earnings per share. Okay. PE ratio, price per earnings, that's okay. All right. So let's take a look at a company that doesn't have positive earnings per share. I'm going to go based on my memory. It could have changed. What do you think this company is? What? Snapchat. How does Snapchat make money? Ads? Do they do it as effectively as Facebook? No. Facebook they were the first one to do this ad-based social media. And so they've gotten really, really good at it. But at least for these first other social media companies that have come along trying to make money the same way Facebook is, they've been operating at a loss. All right, so let's take a look. Let's see if Snap has made a profit yet. That's a wild ride, isn't it? Oh, that's a 1 day. Let's do 3 months. Take a look at all, not 5 year. That's a pretty wild ride. If you had invested up here back in February 2017, you would just now be getting your money back. All right, that's a long time to be waiting. Yep, here we go. Okay, so does Snap pay a dividend? No. Okay. One of the reasons why they may not be paying a dividend, do they have positive earnings per share? No, their earnings per share, they are losing $1.55 for every share that they have. Okay, they're losing money. Tesla, for a while, was losing money. But the price of Tesla stock has kept on doing what? Going up and up and up. All right. So that kind of tells me that when people buy Tesla stock, they're not necessarily buying it because the financials of the company are solid. They're buying it because of what? The name, the hype, right? When you get a lot of people together buying things, can we create bubbles of assets, like where we just keep on buying it, and the price keeps on going up and up and up without there being any solid foundation for that price, any logical reason for that price to increase the way it is? Yeah, it's possible, right? Think about the Supreme. You are familiar with the Supreme brand? Okay, Braxton, you shook your head. What do you think of the Supreme brand? Yeah, they've put a logo on something and all of a sudden it's worth 10 times more, right? I saw a Supreme brick. What did that sell for? Do y'all remember? Let's see. I can't see on that one. $200 for a brick. It is literally what people build their homes out of, but it's stamped with the Supreme logo. And people are willing to pay $200 for it. Okay. Is that kind of crazy? Yeah. That same type of mentality, though, can happen in the stock market as well, where people are willing to pay more and more for a share of stock because they think it's always going to go up and up and up. And that's the definition of a bubble. When prices rise uncontrollably for no reason other than people are wanting to buy more and more, that's when you start seeing a bubble. And what do all bubbles eventually do? Pop, right? So one thing that I think may be a bubble right now, so they just went through a stock split recently. Okay, because at one point Tesla stock was at like $1,300 a share. Y'all remember hearing that? $1,500. Okay. So they recently went through let me pull it up on here. Went through a stock split, and essentially what a stock split is, Talia, let's say you own 10 shares of $1,000 stock. Okay. So that's nice. How much money do you have total? $10,000. Okay. And this stock decides, you know, we're going to do a stock split, a 10-for-1 stock split, because we think $1,000 stock price is somewhat of a mental barrier for people. Because how many of y'all would want to buy into a stock that's worth $1,000? What do you need to have before you can buy into a stock like that? How much? $1,000. Is it a lot easier to buy into a stock that's worth $100? Yeah, it's 10 times as easy, right? So let's say this company that has $1,000 share price that Talia owns 10 shares of decides to go for a 10-for-1 stock split. So for every one share that's worth $1,000, they're going to create 10 new shares, and it's going to drop down from $1,000 per share to $100 per share, right? So Talia, you own 10 shares. After this stock split, how many shares do you own? 100. You're going to own 100 shares, because what the stock split does, they're not going to change how much money, because if all they did was they did a stock split and then the value of all the shares dropped down, but they didn't give people that currently held onto those shares more shares, Talia, would you be upset? Yeah, right. It's almost like stealing from her. So they're going to give you more shares as they drop it down. So Talia will end up with 100 shares valued at $100 a piece. And so her overall investment is the same, still $10,000. Yes.
They also do stock splits whenever they want to keep control of the company.
They really don't do, the stock splits really would not help with that. They may do stock buybacks. And that's when a company decides to buy back its shares. And when the company decides to buy back their shares, the price of the stock goes up. That would help the company maintain control. Because if the company owns the shares, then they're their own owner, right? So Tesla did a stock split. I'm not sure when, but it was $1,500 and it dropped down to $400. So if it was $1,500, everyone who had one share and it dropped down to $500, everyone would get 3 shares, right? Okay, but let's take a look, see how profitable they've been. Debt to equity, look at that, 150, almost 150%. Earnings per share, 39 cents per share. It's okay. It's not great, but it's better than negative, right? Okay. So these are just some things that I look for And does Tesla do a dividend? No, they don't have the money to do a dividend. Okay. So these are some things that we look for, or that I look for when deciding, is this company going to be worth something for me to invest in? Okay. So that's stocks, shares, also known as equities. Okay. Stocks and equities can be used interchangeably. The other main investment, we talked about stocks. What's the other one? Bonds. Bonds represent debt. Okay, when a company decides to borrow money, so this Tesla debt to equity, 143%. When Tesla decided to issue debt to fund maybe their gigafactory or something along those lines, Tesla issued bonds. And so they sell bonds to people. People buy them, and when people buy the bonds, they give Tesla that money, and Tesla gives them a promise to do what? To pay them back at the end of a set amount of period, set time. Okay. So in the meantime, though, a bondholder is going to receive interest. Okay. So dividends are to stocks as interest is to bonds. Okay. The other name for bonds are fixed income. Right. And bonds are going to be a lot like not necessarily safer, but less volatile. A bond price does not change nearly as much because you know that at the end of this time period, you're going to get paid your money back. And in between now and then, you're going to be paid a certain interest rate. So it's going to stay relatively flat. Yes.
Does it have to stay flat seasonally?
No, it doesn't. All that, like in the bond market, the same with the stock market, it's all about what people are willing to pay. So if more people, like, let's say Cade has a bond, right? Leo, if you want the bond that Cade has, you're going to have to offer him money for it, right? Let's say face value is $100. So he has a bond that has a face value of $100. He gave $100 for this bond. But let's say the interest rate that Cade is getting on this bond is 5%. Is that a pretty good interest rate right now? Yeah, you really can't get a 5% interest on anything else. So Leo, what make Cade an offer? Possibly, right? Okay, if your bond is going to mature next month, like if you're going to get your money back next month, you're only going to get $100 back. If Leo's willing to pay you $110 for it, sounds like a pretty good deal, right? But there's some like if it's further away in the future, like let's say this is the first year of a 10-year bond that Cade has. Leo offers him $110. That may be a good deal, but Cade's going to have to do the math to see, okay, what's going to be my overall payout over these 10 years compared to what Leo's offering. Okay. But that's how bond prices can change based on what the market does. Okay. But if you hold on to a bond until maturity, you're just going to get your money back. It's going to be simple. Okay. Now, the other big, so those are the main two big things of investments. The other group of investments that y'all read on were ETFs and mutual funds. What's a mutual funds have been around longer than ETFs. What's a mutual fund? First off, I guess let's start off with thinking, okay, if you invest all of your money into one company, does that create risk for yourself? Why? All the eggs in one basket. What could potentially happen? Company could go under. Are y'all familiar with Sears? They're going under, or they have gone under, right? Okay. AMC theaters, familiar with them? Are they suffering right now? Oh yeah, I saw an article. Let's see if I can pull it up real quick. I have my mail. There was an article I sent myself a couple weeks ago. Oh, well, this is not AMC. But Bed Bath and Beyond, they're publicly traded. In fact, their ticker name is, let's see, BBBY. Okay. They are closing 63 stores nationwide because of the pandemic. Okay. So if you put all of your money into BBBY, right? Let's see what would have happened to you during this pandemic year to date. That's really weird that it's going up right now. That doesn't make sense. But if you bought it back here, okay, and you sold it here, look, at its low, it was $3.56 per share. Penny stocks typically are closer down to $1, but what penny stocks do is they're not necessarily traded on the New York Stock Exchange, or because they're so low and the companies are so valueless by and large, they're not going to be traded on a reputable trading platform or on a brand name trading platform. They're going to be over the counter. So they're going to be kind of between people to people, no market for them. And they're not a very good investment. Stay away from penny stocks. I've lost money on penny stocks when I started off. All right. Okay. But yeah, if you put all of your money into one basket, you could eventually, like, it's possible that you could lose everything. It's also possible, what? If you're more of an optimist, what would be the benefit of putting all your money in one basket? You could get a lot of money. Let's say you put all of your money into the BBBY basket back in April, right? So when it was $3.50 a share, you put all your money that you had into it. Would you have a lot more money now? What's the price now? Yeah, it's over $20. So if you bought 100 shares at $3.50, all right, so 100 at 350, $350. Now it's worth 22. So 100 times 22, $2,000. You turned your $350 into $2,000. Okay. So mutual, real quick, and then we'll end. Mutual funds and ETFs essentially allow you to diversify. You buy a share of a mutual fund, and that mutual fund goes out and they buy hundreds of different companies. And so one share of that mutual fund represents multiple different companies. So you're less likely to lose everything. You're also less likely to hit a home run and it go through the roof, right? But it's going to be kind of a steady. So there's this risk return trade-off. The more risk you're willing to take, the higher your potential return. The lower risk you want, the lower your return. Okay. All right. So this afternoon, I posted a kind of a review worksheet on Google Classroom. Just go through and take a look at that. It goes into commodities as well. Yes.
You pretty much post the same stuff for the, like,
Yeah. People online get the same stuff as people in class.
so the point I don't know if you're still in there.
Yeah. Everything remains the same.